Hey everybody, welcome back to the channel. So today I wanted to look at this topic about what we should do in anticipation of a market bubble. So basically, you see the S&P 500 ratio is at 22.52 right now, as we see on the screen. So I don't think it's very high, but it's not very low either. I don't think we are in bubble territory. Bubble territory will be somewhere around here, or of course here. But what if the S&P 500 does reach those levels? What do we do then? So that is what I wanted to look into in this video. And the question is, whether we should keep holding stocks, equities, or bonds, or have some cash ready. So of course, if you know when exactly the market is going to crash, you want to just have your money waiting in cash. But we don't have the benefit of hindsight. So I wanted to look at some stocks that have gone through the market cycle and gone through a 50% crash in the S&P 500, and and look at bonds too that have gone through that market cycle and what has turned out to be the best option, and maybe that will help us going forward. So I'm using this website called Portfolio Visualizer, and I'm looking at the period from the start of 2006 to the right now, basically, right? And so we have no rebalancing in the account, and I compare it against the S&P 500. So first off, I'm looking at some of the growth stocks, the so-called growth stocks. I own Google and I own Amazon. I don't own Microsoft at the moment, but I want to see how these perform through that market cycle. So basically we can see here, and I'll just scroll down. So you can see here, portfolio 1 Microsoft, portfolio 2 is Alphabet, portfolio 3 is Amazon, and then we have the S&P 500 index. So this looks very good in terms of the compounded annual growth returns, but this is not the focus of this video. The focus of this video is really on the drawdown. So the benchmark here is the S&P 500, and that fell by 50, almost nearly 51% during that market crash in the years 2008 and 2009. And you can see some of these growth stocks fell slightly more, right? So, of course, we know in hindsight that these were great buying opportunities. But if your money was in these stocks, your money would have fallen with the stocks as well. So you wouldn't have had the extra money to buy more of these great stocks. So I want to look at some other companies, so-called defensive companies, and also some bonds, which could have provided a better option perhaps if you knew the market crash was coming, or at least in preparation of a market crash. So I'm looking at the bonds here. This is the 20 plus treasury bond. This is the Vanguard high yield corporate bond, so it's more like a junk bond ETF, and this is investment grade corporate bonds. So these are more high quality bonds. So again, if we look at the drawdown, we can see that the treasury fell about 21%, not as bad as the stocks, right? So if you had some money in treasuries at that time, you could have liquidated it and you could have bought some of those stocks which were at a massive discount. It seems that the best bond was probably this one, the high grade investment corporate bond ETF. The other thing I think we should note is also the Sortino ratio. So very briefly, the Sortino ratio is basically the amount of return you get per unit of risk. So if you're getting 0.76 returns per unit of risk, that's not a very good kind of risk reward ratio. So you want the higher the number, basically the better. Now let's look at some equities. So if you held it through the same market cycle from 2006 to today, how would it have gone, right? So again, we look at the drawdowns during this market cycle, right? And you can see that the Vanguard consumer staples fell about 30%, Pepsi fell about 35%, Coke fell about 32%. So again, not as bad as some of the growth companies. So a small portion of these stocks, could have let you have some liquid crash in those very opportune times, and you could have been a very greedy buyer of some of those growth companies. Here we look at General Mills, Procter & Gamble, and Nestle. Again, very stable, plain vanilla kind of companies. Companies you don't expect to, see massive decreases in earnings during a massive recession. But some of these companies fell hard. General Mills fell for 1%, Procter & Gamble fell 34%, and Nestle fell 34%. So it didn't give us that much protection compared to the S&P 500. Here we look at Yum Brands. Yum Brands owns KFC, it owns Pizza Hut, right? It owns Taco Bell. Sherwin-Williams is one of the biggest Spain companies, and Domino's Pizza sells pizzas. So again, these companies, I don't think they provided enough downside protection in that market crash. Finally, we look at some other companies, and I'm a bit more optimistic about these companies here in terms of providing some downside protection in a market crash. We can see that Colgate, which is the leader in toothpaste, right, among others, only fell 24% during that huge market crash compared to the S&P 500. And McDonald's fell even lesser. It only fell 15%, right? So, and Waste Management is about 30%, so not too bad either. But I think generally the standouts have been Colgate and McDonald's. And if you look at the Sortino ratio for McDonald's, this is quite awesome Sortino ratio. So you get like 2 units of reward for each unit of return here, which is pretty high. Now, so it seems like holding some McDonald's and some Colgate would have been as good as holding a bond, or maybe even better than holding the bond, right? But I just want to issue a cautionary note here is that, at 2006, the price to earnings ratio for McDonald's was a little lower than what it is right now. And you can see these are the different valuation metrics that we have on screen. We have the price to earnings ratio, we have the price to free cash flow, and EV to EBITDA. These are the usual valuation metrics I look at when I'm looking at valuation. So generally, they're all a bit higher now than they were in 2006. So they may not provide the same kind of downside protection that they did in 2006. The good news is Colgate doesn't seem to be that much higher than where it was in 2006. So this might be a good stock to provide some downside protection in the event of a market crash. So I think the underlying logic for both these stocks is basically that, even if there's a massive recession and there are huge job cuts, people are still going to have to eat, and they're still going to go to McDonald's to eat. And people are still going to have to brush their teeth, and they're going to use Colgate toothpaste to brush their teeth. So earnings are not going to fall that dramatically compared to some other companies like maybe Google or Facebook, where companies will cut back on their advertising budgets quite a lot. Or definitely a company like Royal Caribbean will see a massive drop in earnings because people are not going to go for vacations as much, right? But some of these higher growth companies with higher PE ratios will generally tend to fall more. And it's not the part where they fall more that's bad. Is that you don't have the extra cash to buy these companies when they have fallen so much. So that's why maybe holding a little bit of the high investment grade bond and maybe some McDonald's and Colgate could provide an opportunity in such a market crash. So I hope you like this video, and if you do, please like and subscribe, and I want to thank you again very much for watching. Have a great day.